Imagine finding the perfect house. A nice neighborhood. A safe street. Enough space for your family. You check the price and see a number that has become surprisingly common in many parts of the country. $500,000. At first, it doesn't seem impossible. After all, $500,000 sounds like a lot, but millions of Americans are buying homes around that price. So you open a mortgage calculator. You enter the numbers. And that's when reality hits. Because the question isn't whether a house costs $500,000. The real question is, who can actually afford it? And in 2026, the answer might shock you. Most people think affordability is determined by the purchase price. But banks don't care about the sticker price. They care about your income, your debt, your monthly obligations, and most importantly, your ability to make that payment every single month. Let's break down the math. Suppose you're buying a $500,000 home. You put 20% down. That's $100,000 upfront, which already eliminates a huge percentage of potential buyers. Many households don't have six figures sitting in savings. But let's assume you do. That leaves a mortgage of $400,000. Now comes the painful part. With mortgage rates still significantly higher than the ultra-low rates people enjoyed a few years ago, your monthly payment becomes much larger than many buyers expect. Principal and interest alone can easily exceed $2,500 per month. Then add property taxes. Add homeowners insurance. Add maintenance. Add HOA fees if applicable. Suddenly, you're looking at a housing cost that can approach or exceed $3,500 per month in many markets. And that's before utilities. Before repairs. Before unexpected expenses. Now let's compare that number to income. Financial experts often recommend spending no more than 28% to 30% of your gross income on housing. Using that guideline, a household would need to earn roughly $140,000 to $150,000 per year to comfortably afford a $500,000 home. That's not a small salary. It's far above the median household income in many areas. And remember, that's assuming relatively healthy finances. No major credit card debt. No large personal loans. No excessive financial obligations. But many people aren't starting from that position. They have student loans, car payments, credit card balances, childcare expenses. All of those obligations reduce what a lender is willing to approve. This is where many buyers run into trouble. They focus on qualifying, not affording. Those are not the same thing. A bank may approve a loan. That doesn't mean the payment will feel comfortable. There's a huge difference between surviving a mortgage and enjoying homeownership. Imagine spending every month waiting for payday. One unexpected repair away from panic. One medical bill away from stress. One job loss away from crisis. Technically, you own the house. But the house owns your financial life. That's not freedom. That's pressure. And pressure is becoming increasingly common. Because housing costs have risen faster than incomes in many areas. Over the past decade, home prices surged. Meanwhile, wage growth struggled to keep pace. As a result, many first-time buyers face a difficult reality. The house they could comfortably afford 5 years ago may now cost hundreds of thousands more. This creates a dangerous temptation. People stretch. They borrow more. They lower their down payment. They increase their monthly payment. They tell themselves they'll earn more in the future. Sometimes that works. Sometimes it doesn't. The risk is that life rarely follows a perfect financial plan. Cars break down. Jobs change. Families grow. Unexpected expenses appear. The more stretched your budget becomes, the less room you have for life surprises. That's why affordability is really about margin. Margin is the gap between what you earn and what you spend. The larger that gap becomes, the stronger your financial position. The smaller that gap becomes, the more vulnerable you are. Two families can earn the exact same income and have completely different experiences owning a $500,000 home. One family has savings, investments, and low debt. The other has car loans, credit card balances, and little cash reserves. Same house. Same income. Completely different outcomes. This is why wealthy people often think differently about housing. They don't just ask, "Can I buy it?" They ask, "Can I comfortably own it?" There's a big difference. Because homeownership isn't a one-time purchase. It's an ongoing commitment. Roof repairs. Appliance replacements. Property taxes. Insurance increases. Maintenance. The costs never truly stop. And that's something many buyers underestimate. Now, does this mean a $500,000 home is a bad purchase? Not necessarily. For some households, it's completely reasonable. Especially if income is strong, debt is low, and savings are healthy. The problem arises when people confuse approval with affordability. Or when they assume future income will solve today's financial strain. A home should improve your life, not create constant anxiety. And that's the brutal math of a $500,000 house in 2026. For many households, the challenge isn't qualifying for the mortgage. It's maintaining the lifestyle that comes with it. Because the true cost of a home isn't what you pay on closing day. It's what you continue paying year after year. So before asking whether you can buy a $500,000 house, ask a different question. Can you still build wealth after making the payment? Because the people who achieve long-term financial success aren't just homeowners. They are homeowners who still have enough margin left to save, invest, and prepare for the future. And that difference can determine whether a house becomes a foundation for wealth, or a source of financial stress for decades to come.